Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about that big jobs report and what it really means. Before we dive in, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
Weren't we just on stage in another city?
We were, yes. Well, I'm still in Dallas. You're now in Atlanta, I think?
I'm in Atlanta. First time in Atlanta, so I always love the nerd tour in places I've never been to. So
I know some people say Atlanta. Anyway, Atlanta is how I say it. All right. We have a lot to talk about. Most importantly, the jobs report, Jobs Friday that came out on Jobs Wednesday, and really interesting. Supposedly big beat, but let's dig into it.
A few months ago, we did a podcast like what could be the green shoots or the foundation for an outperforming 2026. And, the bar is so low for jobs that anything can beat estimates. And one of the things that we all deal with now are these, revision trends, right? In the big scheme of things, the revisions are just a minor portion of the workforce, but they can bring the headline numbers down. So the job creation numbers for 2025 ended up being 181,000 altogether.
When they revised them.
That was a whole year. Averaged 15,000 a year. Mind that when we started the year, the Fed was like, solid, labor market solid, everything's great. Now, the problem I see now is that, and we've talked about this sometimes, is that anything above 50,000 is a beat, right? And now people are throwing break-even numbers, meaning that population growth is so slow, there's not enough people working, that 15,000 jobs would be a beat. So here it is, 130,000. Where do these people come from?
For January, right?
For January. So that's why I'm not a big fan of the break evens, because if you get a number above 50,000, then it looks like a miracle happened or something like that. However, because of that, the unemployment rate is now down to 4.3%. When you look at the internals of the numbers, it's basically healthcare and social services. Literally, the U.S. growth now is just healthcare. So if you took those two sectors out, we've lost jobs for 12 months. But what that did is that the 10-year yield had gone lower the day before. It shot up right after the jobs report. Then the bond yield started to go lower again, and then it ticked up a little bit toward the end of the day. And then here we go with the John Hamm meme. We're just dancing in the club at night, and the mortgage rate's just like whatever. So a lot of people are interpreting this jobs report in many different ways. So I understand that it's confusing. Just always remember, going back to 2022, we talked about this, that the Federal Reserve will need to see the labor market breaking before they take that next step. So we had a lot of hawkish people. Beth Hammock, Lori Logan, Schmidt, everyone. Hey, we're done with rate cuts, whatever, we need to hold. And this was before the jobs report. Something like this can take the 10-year yield up, but not so much, right? Because we have a lot of rate cuts in the system. Mortgage spreads have gotten better. The bond market wasn't 100% convinced of this labor report. And here we are. A lot of people are confused. Every side is taking their own kind of, interpretation of this jobs report. But just remember, we always believed in this premise. The Federal Reserve will stay as restrictive as possible until the labor market breaks. And this report with this Federal Reserve will mean that, hey, listen, we're going to just take our time. Even with having 181,000 jobs created for the entire year. And literally, it's just two sectors that even got that over. It doesn't matter. I think that I had to spend the whole day telling people, the Fed is like, hey, look, labor isn't breaking. And I think that's where this is such a new ballpark for everybody to kind of walk into, where you just literally had the lowest job growth on the verge of negative, and who knows, the next revision that we'll get, years from now on this will make it negative. But The Fed needs the labor market to break. But now it's a little bit different because so many rate cuts in their system. The spreads are different. So if this was 2023, it's a whole different ballgame. But it isn't. It's 2026. So not much movement with mortgage rates on this day, at least.
Okay, so you brought up something there that as a layperson, not an economist, not even playing one on this podcast, right? So
you just play boss. Wait a second. What was that show? Tony Danza?
Oh no, I'm not playing the boss. I am the boss.
Whoa, who's the boss? Was that Tony?
Oh yeah, who's the boss? Yeah,
yes, who's the boss? Sarah Wheeler's the boss. Logan takes the brunt of it.
That's actually my job. Okay, so but what you said about revisions really strikes me because like if you want to look at that part and go, the revisions for 2025 meant that at the end of the day, like you said, so few jobs created within a whole year. Doesn't, as a layperson, I'm like, okay, so should I trust that these numbers for January are not going to be revised down significantly? Like, how do you approach that?
You don't. You trust but verify, that old saying, but you need a little bit more breadth in the labor data, right? It can't be just two sectors out there. And God, I think the healthcare thing was just literally off the charts for this month. So I understand everyone's very skeptical. Listen, I'm not a Federal Reserve member. I don't work on the board. This is not how I operate. My job as an analyst is to interpret what they are trying to say. And from day one, it's labor over inflation. The only reason the 10-year yield is here is because the labor market got softer, and they're not going to pivot into that, getting off of how slow they want to get to neutral until the thing breaks. And the jobless claims data picked up, but that was, a lot of that was snow. Some of the other internal data lines that people track wasn't very good for this week, but this jobs report, 130,000, which would have been the low end of my forecast in 2025, now becomes this miraculous beat of estimates because there's nobody available to work anymore. And that's why I don't like that break even getting down to 15, because then it seems out there. So the last two reports are clearly not negative. The recent revisions are not as bad. So if you want to make a positive case that now the backdrop is maybe a little bit better, and you're going to get the tax cut bills, you're going to get 100% depreciation. There's all these things that are here for 2026 for positive growth, and then you just hopefully get more breadth in the labor report and push it out here. But for everyone listening, it's what we care about is the 10-year yield and mortgage rates, and another added on the list. Something to where 2 years ago, mortgage rates would have gone up 15 basis points or something like that, and just not much happened again.
That is the really good news about right now with the spreads and everything else. So yesterday at the Housing Economic Summit, you were on stage. Barry Habib was on stage. I was moderating a panel with you two, actually just a Q&A session. And one of the questions was like, okay, well, what's the opposite? Like, here you guys have laid this out. What could derail your forecast on different things? And what was the thing that you said?
Jobs up, right?
Positive jobs.
If I was a labor over inflation guy last year and the 10-year yield getting down to 3.95% was all labor, jobs going up, and getting to 440 to 460, which would be the upper end of the range of the forecast. Not only does jobs get better, wage growth picks up, unemployment rate goes down, right? Inflation is above target. Getting above 460 just doesn't make sense with what the Fed is, but at this stage, but it works both ways. So that's why we do channels and try to work off. But again, we go back to, they announced the mortgage-backed security purchase after the year started. And what did we say on that night? We're like, defensive mechanism. Because if the labor data does improve and yields don't go down to 4% again this year, the spreads give you a little bit of protection, limits the damage. This is a very good example of this today. On a day where the 10-year yield literally shot up 7-8 basis points right off that. It did come down a little bit throughout the day and ended up a few basis points, but The spreads being good to me was always a defensive mechanism if the labor data does rebound, something like this nature. And, a few months down the line, if they see these revisions and they go lower, then, but as long as you have these Fed hawks in play that don't care that it's just basically one or two industries that are pushing the jobs growth, they're talking about inflation more and more. And because of that, there's limits to what we can see. And, technically speaking, we bounced off another level. We're still in that uptrend, and we'll take it from there. But yeah, it was a very interesting day with the jobs data and the jobs week itself. Of course, there's always a snow impact. There's the government shutdown. There's all these things that happened recently, but we're clearing that up, and we're going to have a little bit more of a sunnier feel to kind of work off for the rest of the year.
Positive that we did not see, the 10-year yield go too much higher, but negative in the sense of like what you just said. It's like it just gives fuel to the hawks on the Fed to be like, yeah, we don't need to do that right now. There's no pressure on this. This report does not put any pressure on them to cut. In fact, it gives them something to stand behind to not cut.
Yeah, I just thought of like, what if Kevin Warsh was the head of the Fed, and what does he say with this? Report. The old Kevin Warsh should be, and listen, the labor market's not breaking. We should be talking about raising rates. Kevin Warsh 2.0 is not going to do that. But I think Trump did what he usually does. He said, we need to have the lowest interest rates in the world and that's not how the Federal Reserve operates. They don't look at this as their dual mandate is not interest payments. So
right.
And Kevin Warsh, out of all the Fed people, would be like repulsed about Trump's statement about lowering the rates just to help the deficit. That's not what he is. That's why I always say that Kevin Warsh reminds me of somebody that Paul Ryan and Mitt Romney would like. But for Trump, it's going to be interesting how that relationship works out once he's at the Fed chair.
Okay, so what else do we have this week?
When this podcast comes out in the morning, existing home sales will be coming out. And again, just me personally, when you work from a 9-month high that we saw in December, and then you have that slowdown in the end of December and January, and then you have the snow, you have to get impacted on this report. We finally saw it in our tracker data. Purchase application data came out. It was down just a smidge. And then you kind of just recalibrate things and go out in the future. And again, to me, it's sticking with the forecast. If you stay 6.25 and under, you could get 237,000 more home sales than last year. And that's just taking the normal curve that we've seen, but it's just a duration of the rate slower. Existing home sales should get hit. Right, the data is a little bit funky lately, but once you get past the snow parts, and then you just kind of can push that forward. But the year was actually pretty good before you got the snow impact. And again, our weekly pending sales, our total pending sales, the purchase application data, where the 10-year yield is and spreads, all these things that we talked about at the HousingWire Economic Summit, they're here, they're better now. So everyone get to work. Right? No more. I don't want to hear anybody excuses. Oh, nobody's going to sell their 3% mortgage rates. And they're like, well, there's more people with 6% mortgage rates. And that means, people were selling their 3% or under, or 3 to 4%. So, things got to have to, over time, the affordability gets better, and you just kind of go with that. And hopefully the last 3 to 4 weeks, people can visually see why it's so much better now that the spreads are here, and these rate cuts do matter, right? It keeps it on the lower end. Where 3 years ago, if this was 2023, you get something like this. The spreads are higher. We're 6.75, something like that, and inflation was still not near 2%, But because the labor data got softer, it gave the bond market cover to go lower out there. It was really an interesting day with the bond market. It shot up right away, then it fell down, and people are just making every kind of assumption and theory out there. And that's fun. That's kind of the marketplace, kind of like, people are saying that Ron Burgundy's line as a gift I don't believe you. Bond traders don't believe this labor report, and that's why yields didn't really shoot up higher and stay higher out there, only up a few basis points for the day.
I have to say, we have to give a shout out to all of your nerdy friends who are at the Housing Economic Summit. That was a great day.
I know. It's been a while since I've seen Odetta and Mike Simonson. So I saw them both talking to each other. I'm like, hey, welcome to Nerd Town. There we go.
Yeah. Jessica Lautz was there.
Jessica
of course,
was there.
We had
it is good just seeing everyone's different take going into it. We all have our own different charts, our own different things. Of course, everybody has their own personality on how they present, but I think it's fun. It was a good conversation yesterday at the summit, and everybody had their white. And my thing is, it's very simple. Higher rates brought higher inventory, price growth slowed down, wages are up, wages outpaced home prices, affordability got better there. Now spreads are much better. We had a lot of rate cuts. We've seen this cycle before, and that was kind of the presentation in the scale terms out there. But very interesting year. Man,
super interesting.
I'm going to tell you, it's just this year has been like 24 Jack the show, Jack Bauer. But I mean, wait till Warsh gets in. And how that relationship is going to be with Trump and everything. And Trump's going to keep on calling for like a lot of rate cuts, and he's just not going to get them unless he, is able to boot out a bunch of Fed governors out there. I mean, to me, if Trump's really going after that angle, Beth Hammack would be number one. Beth Hammack would be number one on Trump's hit list to get out. Schmidt would be another one. Lori Logan would be another one, and then you could put Austin Goolsbee and the St. Louis Fed chairman. There are targets out there. If he really wants to go that route, it's just to me, Warsh can't unilaterally cut rates.
But I mean, really, I think Trump is probably waiting to see what the outcome is of that Lisa Cook case, right, before the Supreme Court, because it doesn't do him any good to take all this action, get it through the court systems. He kind of needs to see, like, what are they going to allow him to do?
We'll cross that bridge when we get there. It just seemed like to me there wasn't, some of the conservatives in the Supreme Court were like saying this is not a good idea because if you do it, then the Democrats will do it, and then it just becomes a political football, and then that's not what the Federal Reserve is designed for. And plus, the Federal Reserve is not designed to lower interest rates to bring the interest costs low. This is an internet meme or internet myth that goes on for like the last few years that the Fed has to cut rates because interest payments. No. The funny thing was Kevin Warsh he'd go nuts over this. He'd be like, it's not our job to fix your spending habits, out there. So, man, is this going to get interesting? Powell's probably like, get me the hell out of here, man. I don't want to be part of this drama. I want to go, have a beer and watch Grateful Dead concerts for the rest of the year.
What does Powell do for fun? Yeah, that's interesting. And I just want to say before we wrap up here, thank you to everyone who came up yesterday, introduced yourselves. We met tons of fans of this podcast. Really fun to meet you in person. We got to sign a hat, you and I. I've never been asked to sign a hat before.
Yes, we did. And again, it's always the Sarah Wheeler, Logan Mohtashami, podcast. So I'm glad you're getting the kudos you deserve because you are doing the Lord's work trying to manage this
as people tell
me.
No, I just want to say thank you to all the listeners out there. You guys make us a part of your daily life. We hear from so many people like, you're the first thing I put on, I exercise to you, I walk the dog to you, you're part of my commute. So we really appreciate it. And we are just going to be working every single day to make sure you have what you need to know. And Logan, thank you so much for doing that.
Pleasure. Rock on, baby.